What's up, everybody? You're gonna want to check out this next video from BTP Fusion, Billion-Dollar Losers. Stay tuned. How long can certain companies lose billions of dollars before their investors lose confidence in them and they fail catastrophically, taking down the global economy with them? We're kicking butt and taking names, looking at billion-dollar losers on the next episode of BTP Fusion. What's up, you guys? You're watching BTP Fusion, and I'm your host, Derek West. Let's jump right into what is going on with these billion-dollar losers, shall we? Now, before we do, don't forget to like and subscribe, and click that notification bell so YouTube lets you know when we drop more great content. That being said, though, a lot of people assume, for some reason, that companies on various public and private securities exchanges have a reasonable level of profitability, and that if they are not yet profitable, they will be in the near future, at the very least. The logic being that these companies, at the very least, have plans for growth. And they also, like you, have plans to pound that like button with superhuman intensity. But according to Goldman Sachs analysts, less than a quarter of the companies that are going to go public in 2019 will report positive net income this year, making that the lowest level since the tech bubble of 1999. I would play an infamous Prince song with a catchy hook, which focuses on partying as though it's that particular year. But with the level of profitability of some of these companies, I have a feeling that a lot of people don't feel like dancing. Some of the big names on that list include huge brands such as Uber and Lyft, the ride-sharing giants that have disrupted a decades-old business. Just 24% of the companies going public in 2019 will report positive net income. A year before the internet bubble burst, 28% of IPOs reported a net income in the first year as a public company. The number fell to 21% for companies going public in the year 2000. Back to today. Take a look at this list of companies that are about to go public that are losing billions of dollars, or close to billions of dollars. Focusing in on Uber specifically, Uber went public in May and reported a $1.8 billion loss ahead of its public debut. It also reported a $5.2 billion loss in the second quarter of 2019. Quite a chunk of change to lose. That is more than a lot of people's fortunes. In fact, that loss is bigger than the total 2018 losses for all but 3 S&P 500 companies. Uber Technologies, Lyft, Pinterest, Chewy, CrowdStrike Holdings are just some of the big IPOs this year that seem a long way away from profitability. Other big money losers that have yet to initiate an IPO include We, parent company of WeWork, Peloton Interactive, Cloudflare, a cloud-based provider of networking and cybersecurity services, Financial Straits. Back to Uber. It looks like a major chunk of Uber's losses were thanks to one-off expenses. And as with most one-off expenses, the spending will decline in coming quarters. If we dive in a little bit deeper into the numbers, the losses included stock-based compensation, about $3.9 billion. That is the biggest chunk of Uber's losses. Uber handed out restricted shares that vested when it completed its offering. The value of those shares comprised $3.6 billion of its total stock-based compensation expenses for the quarter. In the next quarter, Uber expects its stock-based compensation charges to fall dramatically. At least that's what the company's chief financial officer, Nelson Chai, is saying. Another source of the huge loss was driver rewards, $299 million. Uber spent heavily on driver rewards connected to its IPO. The one-time charge came out to about the $299 million figure I talked about just a second ago. And then there was research and development. Research and development helps Uber, like many other companies, remain on the cutting edge of transportation technology. The rise of money losers is not necessarily a new phenomenon, however. In 2018, more than 85% of tech companies that went public had negative earnings per share. In fact, it's not uncommon at all for new companies to focus on things like customer acquisition by spending big on advertising to promote brand awareness. Also on competing on price with competitors, and thus taking a loss for a while as they knock said competitors out of the game. And like I said, this isn't new. It took Amazon more than 14 years, 58 quarters, to make cumulatively as much profit as it produced in the fourth quarter of 2017. FedEx was founded by Frederick W. Smith in 1971 after investments of $4 million from himself and $90 million from investors. It didn't turn a profit until July 1975, after some weird and entertaining hijinks. Now the company enjoys revenues of more than $3 billion. Tesla, everybody's favorite electric car company, was founded in June 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk invested in Silicon Valley's first automobile company, and in 2004 became its chairman. It only turned a profit in 2013, a decade after its launch, although it still has numerous challenges it faces even to this day. It is just another example of companies that wait a while to turn a profit. Something you should think about when thinking about companies that lose money? Is this an opportunity for me to buy in? Look at the fundamentals of those type of companies. In fact, examine the fundamentals of all types of companies that you may want to invest in. Determine if they have a product or service that customers want, if they are capable of handling competition from other companies, and if they have room to grow. Lastly, if they can reduce their costs and still remain competitive and produce a quality product. If all signs point to yes, then consider investing in companies that are loss leaders. I know that I'm personally considering investing in loss leaders like Uber because I know that they have solid cash flow. They have a large customer base with some room to grow. I know that their initial outlays will be pared down as those one-time investments go off the books. So, with all that said, they might be a good stock to pick up. Like with anything, the details really matter. Don't let the fact that these companies are losing tons of money keep you from investing in them. It might be a great opportunity for growth. You never know. Just make sure that the fundamentals are sound and you should be fine. Jump in on the discussion and let us know if you're turned off by heavy losses or if you take the opposite approach and look at them as possible good investment targets. If you want some great reading on this topic, don't forget to check out some of the links in the description. Also, don't forget to subscribe for more great content from BTB Fusion, and don't forget to click that notification bell, because in the next video, we're going to be looking at how Amazon is dominating online retail and what you can do about it. So click that notification bell and stay tuned for more great content. I'll talk to you guys later. Take care.